Welcome back. You're with us on Trading Hour, and as promised, let's get into the corporate conversation with Lemon Tree now. The stock has been holding up very well in a weak market after reporting a good set of numbers for the fourth quarter. The company posted a near 30% growth in revenue. Profit rose over 40%, aided by a tax credit. EBITDA came in slightly lower. That's because of some of the investments they're making in renovation and scale-up of properties. To talk about the performance and the outlook, we have with us Mr. Patanjali Keswani, Chairman and Managing Director of Lemon Tree. Mr. Keswani, thank you very much for joining in. So great quarter. The market absolutely loves what you've delivered. Let's start with the sustainability of this, right? Because I think overall, your average room rates in the quarter gone by, they went up in double digits. Now, what are the trends like, and what's the expectation as we look at this season, which is pretty much the peak of the holiday season?
Okay, good morning. Well, seasonally, Q1 is one of the, it's the off-season because H1 in the hotel business is off-season. And while it's holiday season, it's still to come up. So looking at Q1, I would say that April and May were as per our expectations. May is seasonally weak, and this year, of course, with the heat waves and with the elections, it deflated the demand. But looking at the entire quarter, well, I think the ARR, the occupancy, everything is going to be better than the previous year. And I think it is extremely sustainable because there is now visibly a structural shift in demand, and I reckon it will continue for the next 3 to 4 years.
Could you share, sir, the occupancy levels in April and May so far?
Well, that's unpublished. So okay. I don't want to comment on it. All I say is that it is better than the previous year.
Fair enough.
In spite of the fact that May is not going to be, or May has not been, a high demand period because of the heat wave and the elections.
Okay, but it's still better than last year, despite all these adversity. Can you talk about your Aurika, the Mumbai property? What was the occupancy level there? And what's the expectation on that going ahead? And even for Q4, the occupancy ex of Aurika?
So ex Aurika was higher than what we reported. Aurika was less. But in
and
Q4,
what would that number be?
Right, Aurika was about 66%. Remember, it's a new hotel, and it is nearly 700 rooms. So I'm very happy actually with the performance of Aurika in Q4. And my expectation is that once it stabilizes fully, it will be 75 to 85% occupancy. So around 80%, which means we will do north of at least 500 rooms a day on an aggregate basis, definitely from H2 onwards.
Okay. Mr. Keswani, let's talk about overall, additions. What is the number of keys that you'll be adding this year? And these will be across what categories, if you could just break that up into the portfolio?
So we have, we've crossed, well, actually, we will complete our 20th year on 31st May. And at that point, we will have grown to over 10,000 rooms and over 100 hotels. So what I expect is by the end of this financial year, we will have, so there are two aspects to what we add. One is what we add in terms of signings, which may or may not open in the financial year, mostly don't. And then there is what are the hotels that we actually open. So my broad expectation is that we will open, anywhere from, because this is other people's hotels which we manage. So we'll open between 1,200 to 2,000 rooms this year. Another, I would reckon 20 hotels at least. And we will add another 2,000 to 3,000 rooms to our pipeline. So aggregating, we will have 11,000 to 12,000 operating rooms and another 4,000 to 5,000 rooms in our pipeline.
Okay, all right. That's a significant addition. in overall sort of volumes coming through. So again, the second part of my question was to understand at what price points, I mean, are the bulk of these openings happening, and also the share of the the managed properties. What is that at right now? Mangalam tells us that the management fee was up 48% in the quarter gone by. So if we talk about the year as a whole, what's going to be the share of managed properties, and what can we expect at the operating level given the profile of properties that you'll be adding?
So if I look at Q4, we did our owned hotels income was about 330 crores, and managed hotels, if I remember right, was about 180 crores. So if you look at it from the network perspective, our revenue was about 5,000 crores. 500 crores, of which the owned was over 60%. Now, when I look at also the actual inventory rather than the revenue, we own about, out of these 10,000 plus rooms, we own nearly 60%. I think 58% is what we own. But going forward, we are going to add more and more managed hotels. So my broad guess is that managed to owned, managed will cross, obviously, its current level of 42%. It'll go closer to 50% by the end of this year. And in 3 years, I'm pretty sure that our managed inventory will be about 70% of our total inventory. And the price points, of course, vary. So it depends on which hotel opens where. The maximum openings are with Lemon Tree, and a few with Lemon Tree Premier, a few Auricas. And in the franchise side, we will be opening a lot of Keys hotels.
And through all this, you expect your EBITDA margins to sustain above 50%?
Definitely. In fact, as we grow, our fixed costs get distributed. So I'm reasonably sure EBITDA margins will start inching up. In fact, my expectation is that in the next 3 years, they will be north of 55%. The net EBITDA for the company.
Okay. So in 3 years, EBITDA margins will be 55% plus. You'd also said last time that Q4 will be the peak debt year. All your capex would have been completed and you will start debt reduction from Q1 of FY25. That's the June quarter. What's the debt number right now, and how much of your debt will you repay in FY25?
So our debt currently, the peak debt is a little under 1,900 crores on a gross level. Net is a little less because obviously we have cash on our books. My expectation is we are going to spend a large amount of money this year in renovations. So between 200 to 300 crores will be our debt reduction this year. But the following year, it will be, maybe 400 crores and so on. So broadly, as I said, in 4 years, we expect to generate enough cash to pay off our debt and be debt-free. That is assuming that we do not list Fleur hotels. Because if we list Fleur and raise, primary capital, then obviously we could be debt-free earlier than that.
And do you have plans to do that? Is it on the anvil before FI? Yeah, go ahead.
So Fleur is our joint venture with a Dutch pension fund, where about 80% of our debt resides. So if the broad point I was making was that if we list Fleur as an asset company, an asset cum development company, then my best guess is that our debt will become zero in the year that we list it.
So, but when do you plan to do that? That's what I think Reema's question was, that that sounds great from a debt reduction perspective, but this year, next year, where are the talks right now on this?
Well, this is still being discussed, so I don't want to give you a timeline. But I'm saying that this will certainly happen in the next 3 to 4 years. If it happens earlier, then obviously our debt will be zero earlier. But if it happens later, then at worst, we will be debt-free within 4 years.
So either way, FY28 is when you turn debt-free. Could be earlier, depending on if Fleur lists. But anyway, your timeline
is... It's nearly certain we will list Fleur before that. So yeah. I gave a worst-case scenario. But I would hope that if we list Fleur then earlier, then obviously we will be debt-free much earlier than what I have said.
Got it. Thank you for joining in. That's Lemon Tree for you. The stock is up 1.5%.